Hello and welcome to our workshop today on financial modeling. This is your host, Paul Hoyt. As we get started, we'd like to give thanks to our sponsors, Comcast, the City of San Jose, PG&E, the California Department of General Services, International Line Builders, AT&T, the California Water Association, and the nationwide network of elite SDVOB. And a little housekeeping. There are no worksheets with today's presentation, but we do have sample financial statements that are a result of the financial modeling process, and we encourage you to download those and review them at the end of the workshop. And we're going to answer questions here at the end, so if you have some, keep them prepared. This workshop is based on the Awaken CEO system, which is a balanced and comprehensive approach to business growth on multiple levels. In the Awaken CEO system, we talk about 7 different key performance areas: leadership, sales, service and delivery, marketing, product development, operations and administration, and financial management. And today's presentation is focused square in the area of financial management. In our presentation today, we're going to give an overview of financial modeling. We're going to take a step-by-step walk through the process of financial modeling, give you some tips on the financial modeling activities, and sum it all up to the bottom line. But first, some definitions. There are a lot of different terms that are used related to financial modeling, and I want to cover 4 of those right now. Those terms are budgets, forecasts, projections, and financial models, because they're all just a little bit different. First of all, budgets are more for existing companies and typically for a limited time frame. And generally speaking, we compare the results of our activities with the budgets that we have produced and create some variance reports. So, for example, when I was the CIO of a large manufacturing company, I had some budgeted authority. We put in our budget requests before the year started, the budget was approved, and as long as I stayed within that budget, I could expend and choose to spend that money in a responsible way as I wanted to, because I had the budget for it and I had budget authority. Forecasts are different from that. Forecasts predict the future based upon the past, and they're often used in public financial disclosures and loan applications. So if you go to a bank and ask for a loan, they're going to ask for a financial forecast so they can fairly judge your ability to repay that loan. Financial projections are usually more focused on possibilities and somewhat less stringent than financial forecasts. You're not really going to be held to the projections to the same level of detail that you would be held to a financial forecast. Projections are typically for companies with limited history or none at all, where it's really impossible to forecast the future based upon your past results. And the last term we want to talk about is financial modeling. So financial models are projections with some programming to them. They allow changes to significant variables to determine the impact on the changes of those variables and to simulate different financial conditions. And that's what we're going to talk today about, which is the financial modeling process. Now, financial models aren't for every company. Some very early stage companies and internet companies simply don't need them because their revenues are impossible to predict. In fact, their revenue projections are more intentions and possibilities. When they talk to investors, they may say, we intend to create $1 billion company, or we see the possibility of creating $1 billion company, but we really don't want to create a financial model around that. However, both of those companies, early stage companies and internet companies, need expensed and fixed asset projections for the next phase of growth so they can share with their investors what the use of proceeds might be. So they need more projections than they do financial models, and it's typically projections of expenses as opposed to projections of revenues. So why do we do financial modeling? Whether we are an internet company or a startup company or an existing company that's been around for 20 years, we do financial modeling because we want to seek some loans or loan renewals. We may do it because we're raising capital, and we may do it because we recognize that financial modeling is an essential part of business planning, that it really helps with business model due diligence and facilitates the process of thinking through this business plan. Let's chat a little bit about that. So when we do business model diligence, we check the overall viability of the business plan, and it helps us determine the most profitable products, product lines, and distribution channels, and checks the reasonableness of the expenses that we have. When we do financial modeling, we determine the cash that's required to start the business and to grow the business. And in my experience, I've found a lot of times where companies wanted to make adjustments to their business model, to their growth strategies, because of the results of the financial modeling process. And that's my focus. And you should know up front that I really do love accounting. I love debits and credits and referrals and accruals and assets and liabilities and all the terms of accounting. And I just love to do financial modeling. I've completed 150 or so of these financial models, the type that we're going to talk about today. And my focus is almost always on creating investor-grade financial models, which have 6 different published projections or statements. There's the income statement, the cash flow statement, and the balance sheet, both year by year and month by month for the first year. So when I talk about doing the financial modeling process, it comes from a voice of experience, having done, 150 of them or so over the last 20 years as a business coach and business consultant. Before you get started on the financial modeling process, it's important to make sure that you have everything in place that you need before you start. One of the things that you need to have is a strategic growth plan. You need to understand how you are going to grow this business, what your overall goals are, and how you intend to reach those goals. You need a strategic plan, and you need a very good idea about what you are going to sell, who you're going to sell it to, how much you're going to sell it for, and who will sell it. And you also need to have a pretty good idea of direct costs and other expenses. You also need to have a very good idea of the time frame of the financial model itself. 3-year models are the most common, and most of the ones that I do, I would say around 85% of all the models that I create are 3-year models. 5-year models are fairly rare, I'd say about 14% of the time, and 7-year models happen every once in a while. I would say only 2 or 3 of the 150 models that I've created over the last 20 years has been a 7-year model, when the company really needed it. It's important for you to know the time frame before you start, because once you've completed a financial model, it's really very difficult to change that. In fact, you almost have to start over every time. And frankly, longer models are less believable, and that's why most models are 3 years. You'll find that investors and bankers and anyone else who wants to try to fund your business really wants you to break even within about 18 months and be in a position to give them a return on their investment within 36 months or 3 years. So the overwhelming majority of the financial models that I create are 3-year models. Let's take a look at the financial modeling process. There are 10 steps in the financial modeling process that I use: startup expenses, sales projections, a staffing model, direct costs, operating expenses, balance sheet activity, cash flow analysis, capital engineering, other expenses, and finally, we end up creating the dashboard. We're going to take a look at each one of these 10 steps in the financial modeling process, one at a time. Let's start with startup expenses. This step in the financial modeling process is optional. It really doesn't make any sense for companies that are in operations and insignificant revenue to have a startup phase to their financial model at all. But for those who are just starting, it's usually from 3 to 9 months long, prior to having revenues and any major expenses. It really helps to isolate those startup expenses from your operational expenses, because it helps with the analysis of the first year of operations. If you have a lot of startup expenses, non-recurring expenses for product development, legal fees, for startup branding fees and marketing fees, etc., in your first year's operational projections, it really clouds your ability to take a look at the profitability of that first year of the company. Isolating all of those expenses from the first year of operation also tends to increase the operating income projections in the last year of the model, which is important to valuation. By setting those things apart, you're essentially going to be sharing with your investors that the company's going to be worth a little bit more in 3 years or 5 years or 7 years than you would if you incorporated all of those startup expenses and that startup time before revenue into the primary financial model. Once you've completed the startup expenses, then we move on to sales projections, where we project our sales by product or product line or even by distribution channel so that we can properly project the revenues that the company might enjoy. In order to do this, as we said before, you really need to know what products you want to sell, the prices and the costs of each one of those products, the number of units of each one of the products or product line you're going to sell by the different channels. For example, how many you plan to sell retail versus wholesale, and the price and direct cost variations by channel. I've had an occasion to go into some financial modeling sessions and ask this first question: how much are you going to sell and who are you going to sell it to? And 15 or 20 minutes later, they're still struggling with coming up with that answer. If you're struggling with coming up with that answer, then you just know that it's not time to do the financial model. You need to sit back and do some of the basic homework first before you engage in the financial modeling process. And by the way, when you create the sales projections, at the end of that, you've probably done about 40% of the work in the financial modeling process, even though it's only step 2 of a 10-step process. After the sales projections, we move on and complete the staffing model. We want to know the salaries and the starting dates of all of the people who are going to work at your company, and contractor fees and engagement dates of those you intend to hire as contractor in detail for the first 12 to 18 months. And for some companies, that's really only the first 6 to 9 months, and less so thereafter, because the financial modeling process that I like to use automatically expands the number of people on the staff based on revenue per employee assumptions. Be sure to include within that your bonuses and raises. Now, the reason we do this up front is because the staffing expenses are typically 50% of all of your operating expenses. So we want to pay a lot of attention to this particular operating expense category because it is typically such a very large percentage of your overall operating expenses. Once we've completed the staffing model, we move on and then calculate the direct costs, which includes a lot of different things. It includes the product cost or the direct costs of goods sold, but it also includes subcontractor fees or direct delivery costs if you're hiring somebody specifically, for example, to deliver the services that you sell to people. And it also concludes commissions, internal commissions at all of the different levels of the company, and external commissions that you might pay to agents and brokers and affiliates and those who refer your products and services. It also must include royalties and credit card fees. The reason we do this next is because it's typically 40 to 60% of all of the revenues of the company. So once you've defined the staffing model, which is about 50% of the operating expenses, and the direct costs, which are 40 to 60% of the revenues, you've typically defined 60 to 70%, maybe even 75% of all of the expenses that the company is going to incur whenever it sells something. Once we have completed the direct costs section of the financial modeling process, we move on to talking about the operating expenses, and oh boy, there are a lot of them. It's a very, very long list. Automobiles, bank fees, board of director fees, communications, contributions, dues and subscriptions, education, employee relations, insurance, legal, marketing, office equipment, office rent, office supplies, payroll taxes, and printing. And wait, product development, professional fees, software, sanitation, taxes and licenses, travel and entertainment, uniforms, and utilities. It varies a little bit from company to company, but there are a lot of operating expenses, and I like to go through each one of those line items in detail. Some of those operating expenses will vary by the size of your staff, And most increase over time because fixed expenses are rarely fixed. About the only condition that you would have a fixed expense that would remain the same for the duration of, say, a 3-year financial model is if you had a contract, if you had a lease on, say, a particular facility and you knew you weren't going to outgrow that facility and have to move within 3 years, you could call that rental expense or that facility expense a fixed expense. Likewise, if you were leasing some equipment for your shop floor and you knew how much it was going to cost for the next 3 years, that might be a fixed expense. But other expense categories, automobiles, marketing, insurance, office supplies, all of that vary with the number of people that you have on staff and the revenue that your company enjoys. After we forecast the operating expenses, we moved on to balance sheet activity, where we talk about things like accounts payable, how much of this month's accrued expenses you can defer to next month and make accounts payable as opposed to reducing the available cash in the current month. Notes payable, how much money have you borrowed and your intentions and obligations of repaying that debt. Distributions of profit, when, if ever, do you plan on distributing profits to the shareholders in the company? Accounts receivable, when do you expect your clients to pay you? Do you expect them to pay within 30 days or 60 days, or are you going to give them terms for longer payment plans? Notes receivable, if you issue notes to people, when do you expect them to repay the notes? Prepaid expenses that you might have when you prepay rent or prepay some other things. Inventory, how much inventory you're going to have on hand to safely meet all of your obligations when it comes to selling. Fixed assets and other capitalized expenses such as building and land, computer equipment, office furniture and fixtures, plant equipment and machinery, and product development expenses that may be capitalized, and trucks and automobiles expenses. So as you can see, you can consume a lot of cash out of the business on things that are not related to income and operating expenses in each of these different balance sheet categories. Once we have completed that, then we move on to do cash flow analysis, where we do a month-by-month analysis of the cash required to grow the business. And it does take a significant amount of cash to grow a business. You need cash for inventory, for accounts receivables, for fixed assets, for marketing, for staff and staff-related expenses, and for debt repayment and working capital. Once we've determined how much cash it's really going to take to grow the business, then we move on to capital engineering, where we project the amount of the cash that's required and always budget for a little bit extra and determine what our sources of capital are going to be. Our founders' contributions, debt, both traditional and non-traditional debt, and cash that may come from investors. And with capital engineering comes the ability to project the company's valuation using one or more of a lot of different models that are available. The Harvard method, the internal rate of return model, the fair market value method, and there's many others on the marketplace. You want to make sure that you give your investors a reasonable return at least, or even a fantastic return. And then once we've completed the capital engineering, we can move on and project other expenses like interest, amortization, depreciation, and taxes. And finally, we conclude by creating the dashboard. When we create the dashboard, we determine the most significant variables in the financial model, which are typically things like revenues, direct costs, marketing expenses, days sales outstanding, which is what we need to calculate accounts receivable, whether we expect our clients to pay in 30 days or 45 days or 60 days. And then we complete the dashboard by creating the programming that allows changes to ripple through and show what the top-line revenues are, the gross margin, the operating income, the capital requirements, and the valuation of the company whenever we change any of those significant variables. So that's the process, the 10-step process for creating an investor-grade financial model. Startup expenses, sales projections, staffing model, direct costs, operating expenses, balance sheet activity, cash flow analysis, capital engineering, other expenses, and the dashboard, all projected month by month for 3, 5, or 7 years so you can determine your true cash flow requirements to grow the business according to the business model that you intend to employ. Here's some tips. First of all, it really does take great spreadsheet expertise, accounting expertise, and domain expertise to create reasonable models. When I do financial modeling for my clients, I say I'll bring the spreadsheet expertise and accounting expertise, but generally you have to provide the domain expertise. You're the only one who knows what you're going to sell, who you're going to sell it to, how you're going to sell it, and how much it costs in order to build the products in the first place. A lot of CPA firms and bookkeeping firms, frankly, don't do financial projections. They're focused on historical financial results and government compliance as opposed to financial forecasting and financial modeling, which is forward-looking. And like business plans, your financial models really do need to be updated every 90 days or so. Some financial modeling professionals, by the way, don't deliver the spreadsheet, so be cautious of this. Whenever you engage the services of an outsider to help with your financial model, make sure that you get the Excel spreadsheet when they're done with it so that you can make minor adjustments to the financial model yourself, or you can hire the services of another contractor to update the financial model over time. Unfortunately, I have seen some financial modeling firms just keep the spreadsheet, so you always have to engage their services at many hundreds of dollars an hour to update the financial model whenever you need to do so. And as I kind of mentioned, it really does take month-to-month balance sheet, income statement, and cash flow statements to understand how much cash is really going to be required to build the business. And one last thing, no financial model ever comes true. If you create a financial model that's plus or minus 20% of what actually happens during the next 3 years, you've done an incredibly good job. So here's the bottom line. There are a lot of great reasons for you to create a financial model. And if you're going to share them with professionals, I'd strongly encourage you to make them investor grade and get professional support when you do that. That's been our agenda for today. We've talked about an overview of financial modeling. We've done a step-by-step walkthrough of a financial modeling process, and I've offered some tips on financial modeling and summed it all up to the bottom line. Before we take questions, we want to again thank our sponsors, Comcast, the City of San Jose, PG&E, International Line Builders, the California Department of General Services, AT&T, the California Water Association, and the nationwide network of elite SDVOB. Now, let's take a couple of questions. Here's the first question. How long does it take to create a financial model? In the process that I use, it typically takes 6 to 8 hours. And by the way, that is really quick. I've seen other firms that may take 3 weeks to create a financial model, but I've done so many of these that my template is very well refined and I can do them in about 6 to 8 hours. We usually either do that in one day or we block out 4-hour financial modeling sessions on successive days. It's important to not let too much time go by in between the first half of the financial model and the second half of the financial model because we forget and we have to review, and overall it takes a lot longer to do that. But the big key is you have to be ready to do the financial model. When I ask, how much are you going to sell and who are you going to sell it to and how much is it going to cost to build it or deliver the product to the clients, you really do need to know the answers to that. And if you do, it takes a little bit less time. And if you don't know the answers to those, it can take a very long time. So with clients, often we create a strategic plan before we go into the financial modeling process. We have to know how we are going to grow the business over time, what markets we're going to serve, how much it's going to cost to develop the products and services, what the product rollout sequence is, and all kinds of things related to the strategic growth plan before we can take that strategic growth plan and create a financial model that fairly represents the dollars and the cents associated with that strategic growth plan. So the strategic planning process comes first. When you have your strategic plan completed, then and only then can you start in on the financial modeling process. And if you know the answers to all of the questions that are going to be asked ahead of time, we can complete that in about 6 to 8 hours. Here's question number 2. What is the difference between financial modeling for a nonprofit and a for-profit? And the answer is that really not that much, because most nonprofits also sell things. They don't just give away all of the funds that they have donated to them. Now, some do. Charities oftentimes do, but oftentimes charities also sell a little bit. They sell something to their membership, to their constituency, and gain some revenues with that. So they need to project those sales in the same way that they project donations. There's some differences when it comes to establishing the balance sheet. Nonprofit organizations don't have capital expense, although they can capitalize and depreciate some of their assets, and they can amortize startup expenses. They typically don't have near the complexity of a for-profit model. That doesn't mean that nonprofits are simpler businesses to operate, because they're not. The business of seeking donations, of gaining grants in order to get the funding that you need to fulfill your charter as a nonprofit is very complicated and difficult. So it's not an easier business, but it's a slightly easier financial modeling process. Third question. How often do you recommend updating your financial model? And that really depends on whether or not you're an operating business or you're a business that is seeking capital and seeking funding. So if you're going outside for bank loans or for alternative debt financing, or if you're seeking investment, you have a fiduciary, and that means legal responsibility to fairly disclose the status and the plans of your business to those who would fund your business. And that means updating every 90 days or so, or any time that there's a material change in your financial condition or a material change to the growth strategies of your business. So, for example, if you get 45 days into executing a financial model, a financial plan, and you find out that something's just not going to work for you, or if you have the happy experience of finding out that a product or a product line is really starting to take off, you definitely need to or want to update the financial model in order to fairly disclose, again, the financial condition of the business and the financial projections, the growth strategy of the business, to potential funders of your business. And here's our last questions. If financial models really never come true, then why do you do them in the first place? And there's really a couple of reasons for that. Number one, as I just mentioned, you have a legal responsibility to fairly disclose the growth projections, the plans of the business to anybody who might want to invest in your business or loan you money. It's really important to do that, to honestly and fairly project your financial conditions to those who may want to fund you. But the second reason, I think, can be even more valuable and can be a really good reason to create a financial model even when you're not seeking outside funding. And that is it gives you a plan, so that as you begin to grow your business and you begin to execute your business plan, you can see how that lines up with your financial plan, and you can make adjustments to that. You can see when you might need to go out to raise capital, or when you might be able to invest more in products and services because you either have more cash than you thought that you were going to, or less cash than you thought that you were going to. So I'm a big believer in having plans, not because plans always come true, but because plans give you something to measure your progress against, so that you know whenever you need to have more money, or whenever you're enjoying more cash than you thought that you have, so you could take that cash and invest it in product development, in marketing, in some other program that will further accelerate the growth of your business. That's been our presentation today on financial modeling. I hope you have enjoyed it. This is Paul Hoyt with VetHelpVet. If there's anything that we can do to help you in your financial modeling processes, or with anything else related to growing your business, please reach out. We'd love to have a conversation with you. Bye-bye.